I don't think that there's pause or cause for concern there. I wanted to make sure we showed this graph because I want to show you what's going to be happening over the next 1 to 2 to 3 years. Right now you can see this graph and you see all the blue lines, the blue jagged lines, right? Those are the actual home prices that have happened since 2001 all the way to 2021. And that red line that's going through the middle, it's red, right, Pablo?
That's right. That's right.
That's red. Nailed it. Colorblind guy right here. That is the median projected home sales price based on our historical average, right? So 4.3% each year is what this goes up. A couple key takeaways. We talk about home prices being cyclical, right? Home prices come back because of supply and demand and home price affordability. They come back to the norm. Use this information to your advantage to make the right decision for yourself and buy and hold, right? One incredible data point that everybody should look to is, the Great Recession was probably the most volatile real estate market we hope we will ever see and probably will be, right? If you go back from 2001 to 2021 and you follow that trend line right there, it goes up 4.3% each year. We're now meeting it in 2021. That means that over the last full real estate cycle, what I just shared with you about real estate being cyclical absolutely rang true. In the most volatile time when prices ran way up during the Great Recession, they ran way up prior to the Great Recession, then they fell after the Great Recession, it still rang true. So one could conclude that as this has happened decade after decade after decade, this was the biggest stress test that we probably have seen. You still hit this long-term 4.3% trend line. What's going to happen over the next real estate cycle is probably going to be roughly the same end result. That's why I love investing in rental properties so much, because you sort of have the answers to the test as long as you hold on long enough, right? So even though I'm sitting here telling you that I expect home prices to jump more in the next 12 months than I expected and that more than happened last year, I still believe, and the reason I put my own money into this, that when I'm looking back over 10, 15, or 20-year segments from right now, I'm still going to see roughly 4%, 4.3% average annualized appreciation year over year. What I think you're going to see, especially over the next coming years, is you're going to see us go above that line. Okay. Now, the fact that the actual home prices would be above that line is not, you shouldn't just look at that in a vacuum and say, wow, we're an overpriced market or that home values are going to crash, right? That would be one indicator, right? That home prices are higher than the national median. That'd be one indicator that I would look at and say, all right, are we going to see higher than normal home price appreciation in the future or lower than normal, right? What I would see there, if we're way above the line, then we'd probably see lower than normal. Again, not the same as a crash, not the same as depreciating prices, just lower than normal. Another thing to look at, of course, is months of inventory, right? If you look at months of inventory and you see 15 months of inventory and we're way above the line, then my conversations with you will be something to the effect of, I see something seriously changing with prices in a negative direction at that point. But right now where we stand, we've never been lower for months of inventory. We are at the trend line right now, and it's very normal for us to go above the trend line. That's how this works. In a normal real estate cycle, you go above the trend line for a little while, then it smooths out, right? You have less than 4% appreciation as the trend line catches up. And then many times you don't drop prices, you might appreciate at 1% or 2% for a number of years or 0%. Right? But it's just not normal that you have this crash. And so as I look forward into the future, I would expect us to see higher than normal home price appreciation, put us above that line. I think slowly but surely you're going to see months of inventory get more in line into that 6 to 7 range. And then you're going to see the same thing happen over the next real estate cycle, which is roughly about 4% appreciation, just with less swings, less run up before the Great Recession, less drop after the Great Recession, but you're ultimately going to get to the same answer.
Got it, Greg. So, graphically, what you're explaining to me is these swings, right? These micro swings that happen here are normal, and it's going to dance on this line. The big outlier that happened here was the idea that it went so far, like this delta right here is something that you don't see coming again. And we'll see it coming as it's happening, right? Like it's just more so that we've been used to this below the line consistently, but normally what's going to happen is it's just going to dance on this line with this level of variation, kind of a similar trend that's going to continue going up, as opposed to this like bubble that you see here, right? So like what we see here though is, number one, a giant delta between the median price and, you know, like what it's expected to be. You see this big thing. And then on top of that, like you said, right? What was months of inventory at this point? This is what, like around 2006 here?
Yeah, actually, I know it from December 2017. Months of inventory was 18 months of inventory.
18.
So if we got to a place where we were that above the trend line, actual home prices were that far above the trend line, and we had 18 months of inventory, I would be telling you prepare for another great recession. But I don't see that happening.
Yeah.
And even if that happened again, if you hold on for a full market cycle, you still wound up, you know, in a place where your home prices actually got back to the norm of 4 to 4.3%.
Yeah, makes sense. I mean, you guys bought a bunch of your real estate here, right?
I did.
And you're still doing okay with it, right?
But interesting thing, because I'm seeing some of the chat here too, and I think this is a really good point. You know, people say, well, Greg, if you go 20 years beyond, you know, the numbers work. Try going 10 years beyond. Okay. Well, let's not even say that. Let's say that I took this trend line from 2006, right? If I did 2006 to 2021, I would not have appreciated at a rate of 4.3%, right? Okay. So you don't always know if it's going to be a 10-year, 15 or 20-year cycle, right? You know, the reason that we call this cyclical is because as we look back in over time and we see 10, 15, 20-year periods of time, you largely see that your appreciation rates on average are right around the historical norm. If you have a huge outlier like the Great Recession, you would expect that you need that full 20 years to get there, right? Right? You don't normally have that huge outlier like the Great Recession. But here's what's interesting. You know, I'm talking about how market forces work in your favor. Supply, demand, home price affordability come together to ultimately, you know, absent a large change in that region economically or livability or whatnot, absent that, you're going to see it come back to that same historical norm. Well, what's going to be happening here that I've just said over the next 2 to 3 years, right? You're going to see much higher than normal home price appreciation, right? If I took this chart just from 2006 and tried to make this, you know, as dire a situation as I wanted to, 2006, the height to where we are pricing right now is not 4.3%. I would imagine after the next 2 to 3 years, you're going to get closer to 4.3%. Right? Because I'm saying home prices are going to go up so much, right? So it just goes to show you that these are how things work in real estate. It's why I love this asset class so much. I don't have to be Nostradamus here, right? I have to buy an asset. I have to be into it to buy and hold for a full real estate cycle to maximize the 5 profit centers. And I simply need to be in the game. And that gives me comfort. I understand this. Hopefully you all understand this. You don't have to understand different, you know, things that the stock market really throws at you and all their indices and all of their metrics and what does this mean? And sometimes when you understand them, it doesn't even line up with what the actual stock price is doing. Like this is tangible. It makes sense, hopefully, for all of us. And a lot of this, I feel like you have the answers to the test as long as you're in the game long enough.
Jen Filson had a great question from before that I was waiting till now because it's more germane to the conversation. She asks, question, some predictions for real estate say there may be a 20% market correction in 2022. What does Greg feel is going to happen to JWB investors' positive cash flow properties in Jax if house prices drop? So I guess, you know, you've kind of disproven the idea that you think that, or at least it's clear that you don't think there's going to be a 20% drop in 2022. But maybe answer this in the macro. What happens if house prices drop? What happens to cash flow?
Wonderful question. You know, I wouldn't agree with that happening in 2022, but I think the cool thing is that you don't have to agree with me on this in order for this investment to make sense. Let's talk about worst case scenarios. Pablo knows me pretty well by now. He knows that a lot of times I think in what's the worst case scenario, and if it's If it's okay, then I'm going to move forward and, take a healthy amount of risk. Well, I lived through that worst case scenario, Jen, in 2006. I was, a young kid, didn't have much real estate experience, didn't have much money, and just really fell in love with this asset class, and bought about 40 rental properties with my business partners. And to do that, we learned how to use financing to our advantage. So we had these financed properties that we bought at the absolute height of the market. If you look at that absolute top part in 2006 on that graph, that's where I bought 40 rental properties. So I want you to know, Jen, that I know exactly what the worst case scenario looks like, because at that point, the market then proceeded to drop, call it 35% over the next 2+ years. So what happened to me? What really happened with those rental properties? Well, many people think that home prices and rents are directly correlated, and they're not. For me, as a kid who had a lot of debt at that time, good debt because it was on rental properties, and I didn't have a lot of income at that time, it was a fledgling business at that time. The only way I was able to hold on to those assets is because they produced positive cash flow month after month after month. Even as home prices were falling, rents stayed strong, again, because people needed a place to live. That's why I love this asset class. It's investing in a critical need. And as long as the jobs stayed in our local economy, which by and large part they did, the jobs provided the income for the renters to be able to pay for the rent, and the rents stayed consistent for us. So, in a worst case scenario where you see a market crash, you have a couple of things working in your favor. Positive cash flow on the way in is a risk mitigating factor, right? That means that it can pay for itself it pays for itself every single month, no matter what housing prices do. So that mitigates your risk. That's why I went into this as a conservative guy and said, I'm going to buy 40 of these. It's because I knew that the fundamentals were that whatever housing prices did, the rents were going to pay all my payments for me. And that's what we saw. That's a big reason why you need to choose a market that is built to withstand, some economic, built to withstand changes in the job fronts on the economy, right? You want to choose a market that has over 1 million people. Jacksonville has 1.5 million people because you want to have a diverse economy. We have 3 Fortune 500 companies. The Navy is the largest, and the military is the largest employer here in Jacksonville. We have Amazon distribution facilities. We're a logistics hub. We have the largest container port in the state of Florida, right? We talk about all of these things because that
Healthcare.
solidifies healthcare, right?
It's all-
Fintech. We're going to talk about fintech soon. We just confirmed the CEO of FIS, which is a Fortune 500 company. Gary Norcross is going to be joining us on the show in the not too distant future to talk about fintech and talk about Jacksonville. So anyways, you do all of that research. You make sure you're in an economy that you feel strong, that the job base is going to be strong, and it mitigates a lot of your risk. And for me personally, in that worst case scenario that I lived through, it actually wasn't a worst case scenario at all. It didn't affect my way of life at all. I didn't plan to sell those properties over the next 3 to 5 years anyways. I planned to hold them for cash flow. They did exactly like they were supposed to. And I still own them today. They're a part of my portfolio. So in the unlikely event that you would see a market crash in 2022, which I do not see, and many people in my space do not see, I think you're going to be fine. I'm still going to feel really good about telling people that this is a great decision, again, with the caveat that you're in it for the long haul. Because if you hold on for a full market cycle, that's how you win in rental properties.
Yeah, it makes sense, Greg. And to juxtapose that to other markets, right? Like it's a combination of all the things that work well inside Jacksonville, right? Because it is this idea of low pricing, higher rents, and this asset class. But I think what you hit on last there, the economical mix of Jacksonville is huge for the idea, and the fact that you are providing workforce housing is big for the idea of worst case scenario. Because Margaret puts in the chat, our rents crashed, tenants disappeared overnight, looking for where jobs are. They're in Sarasota, which is too heavily dependent on building trades, 2007, 2008, and that came to a sudden halt. So a national phenomenon is felt differently depending on your local situation. Me on the other side of the equation, when I was in my, I was in construction, working in the construction trades, definitely affected my livelihood. Came back to Miami, that's also super real estate and construction dependent, and highs and lows of of that scenario, and the tourism dependency, right? Like, so when the economy isn't doing well, people aren't building a lot, people aren't traveling a lot. So if you're looking at those things, that's one. But logistics, healthcare, the military, government spending,
Yeah.
all that stuff is a big buoyant force of what the floor is, of what the worst case scenario is. Makes